Welcome to this episode of Business Redefined. This year we have come to you from Addis Ababa in Ethiopia. We have come to you from Accra in Ghana. And right now we are coming to you from Rio in Brazil. Copacabana, fantastic place. We are here to discuss matters regarding the global financial architecture and what it means for the global South economies such as Kenya when they are facing elevated debt distress levels. That's the position we have been in. We have seen Zambia default, we have seen Ghana default, we have seen Ethiopia default. So I sat down with two gentlemen to focus on this matter, and where we started our conversation was the state of the global financial architecture and whether it is optimally structured for distress resolution when a sovereign or a country falls into problems.
What we have now is a legacy to some extent of the aftermath of the Second World War, because after the Second World War, there had been this conference, Bretton Woods conference, to lay the foundations of our current economic and financial order. And at that time, it was a matter of power. The victors, they create their own system, and in particular a system under US dominance, saying that all the currencies, existing currencies, would be pegged to the US dollar, and the US dollar would be the only currency pegged against gold. And that means that, as the saying goes, the dollar was as good as gold. But when this system was created, in fact, most of the countries in Asia and Africa were still colonies. So they were not represented at the Bretton Woods Conference. And the system was not made for them. And as some scholars have shown, there has been a contradiction within this system. Because this system was based on the idea that there should not be imbalances, trade imbalances, but equilibrium in terms of trade relationships between countries. And at the same time, there was the kind of commitment that the richer countries should transfer net resources to the poorer countries. So if you want to transfer resources to the poorer countries, that means that there should be imbalances. While the currency system, monetary system, was based on the idea that there should be no trade imbalances. So this has been a problem of this Bretton Woods system. But another problem has been that, well, it was the context of the Cold War, and the US also tried to cement further its hegemony, military hegemony across the world. So the US started to spend a lot in US dollars. And normally when you spend a lot in US dollars, you will have trade deficits.
Well, its state presently is very clear. It's an intensified version of what it began as after the Second World War, which is as a set of institutions and then subsequently a set of markets, because it was not just multilateral organizations and so on, but which served the interests of the dominant powers, the dominant market economy powers or capitalist powers. And this became very clear when the WTO was set up, because despite the fact that it has a vote for every nation, we know that there is no decision which goes through the WTO which doesn't have the sanction, implicit or explicit, of either the United States and Europe. So that was what it started as. But the point is that that the power which came from where the United States was after the Second World War was sort of strengthened in the period after, let's say, the 1980s, when a substantial amount of finance capital located predominantly in Wall Street or New York decided to move into developing countries, and associated with that was a substantial degree of removal of regulations which developing countries had put in place after the Second World War to insulate themselves in part from the adverse consequences of integration with powers like the United States and Europe and of the advanced, the metropolitan countries. So that opening up actually, and the fact that you had this huge amount of liquidity which was being created by the United States Central Bank, moved into these countries, and therefore you not merely had the power of the institutions which were created at Bretton Woods and subsequently, but you also had the power which came from the fact that your finance capital became the principal source of access to international liquidity for these developing countries.
Countries are paying high interest rates on the foreign debt, they issued. And that has been how the system has worked for most of the countries across the global south. So that means that there is a need to be in deficit, because you could have developmental deficits. Developmental deficits means you have to industrialize and you have to make sure that you have all you need for your industrialization. But this is not allowed by the system. So at one point what happens is that countries will borrow, but as their foreign earning capacity depends on the prices of their commodities, the day they have a shock, a negative shock on the commodities they export, the markets will say, oh, now you will become insolvent and we could no longer lend to you. Or if you have to lend, it will be at high yields, high interest rates. And that has been the story of Africa.
One of the big elephants in the room when it comes to the process of sovereign debt restructuring is the question of haircuts and who should take it. So ideally, it has been argued for a long time that multilateral development banks such as World Bank, IMF, Africa Development Bank should not take haircuts in the process of restructuring because they are deemed to be preferential creditors. So when you talk about how much creditors should be foregoing in terms of what the debtor owes them, they are not affected. But this is now being challenged, especially in the present environment where a number of countries have fallen into debt distress. Should MDBs or multilateral development banks take haircuts? I put that question to my discussants.
No, you see, so what's their point? Their point is that, listen, we need to keep our AAA ratings, because without the AAA ratings we cannot borrow cheap, and if we cannot borrow cheap, we cannot actually fulfill our mandate, which is a global mandate. It's all nations. All of these nations are members of these bodies. Now, there are two issues. I'll say three issues to this. The first issue, of course, is that their money is largely the money which the erstwhile bilateral creditors partly gave through bilateral sources and through multilateral means. The bilateral flows from the Paris Club have frozen. They're the so-called aid fatigue. It's a very nice term. So they're supposed to be. They've given you so much that they're fatigued. So whatever little they put in goes through the multilaterals. Whereas a country like China is giving a lot more direct bilateral credit. So if you say that multilaterals shouldn't take a hit, then you're saying that it's bilaterals and the private creditors must take the hit. Private creditors are not willing to play ball. So you're basically saying that I'm going to force bilateral creditors through the offer of financing assurances, as they call them, when the whole decision to finance goes to the board at the IMF. You're telling them that unless you give these assurances, this poor country is going to be in a mess. So the first is it is a way. It's not a question of multilateral. It's a question of developed countries, developed market economies, finding a way to actually not take responsibility for things that they're partly responsible. That's one. Second thing is that why would an MDB have this AAA rating? It has this AAA rating for two reasons. One is that there is an implicit assumption that it being a body which is backed by the developed market economies has their backing. It has an implicit, they have implicit sovereign guarantees from the strongest nations ostensibly of the world. So if anything happens to them, they're expected to be bailed out. And two, the borrowers are all members by treaty of these organizations. So anyway, they're not supposed to default unless they're really in desperate states. Okay? So you can't then say that I'm getting my AAA rating because of this. But you actually say the reason I'm getting it is because I'm a preferred creditor. It's because they always pay me back. You have to say that, listen, I have this advantage, and if I've actually been partly responsible for creating a situation where somebody can't pay me back, I must help rescue that. I mean, virtually I'd say you need to put your good money after that bad money, because you're partly responsible for that money having gone bad. So you put all of this together and it just doesn't make sense. You're basically saying that, listen, this is a way of transferring the burden of adjustment to a new player in the international market.
You know, there is this view called the African premium. That means that the African sovereigns, they are paying much more, you know, everything else equal. There had been, for example, a study by two economists, Michael Olabizi and Howard Steen, and they showed that, for example, when Greece was, you know, the Greek economy was in complete tatters, Greece was facing interest rates lower, you know, than African governments, which were, you know, enjoying economic growth due to the commodity boom. So there's a kind of a discrimination against African sovereigns, you know. But every time they will say, oh, no, we have very, you know, sophisticated models, etc., and we price everything well, we price the risk well. But that's not the case. But the thing is, every time, why do we need to issue debt in foreign currency? And there, I mean, we have to think about that, because African governments, they have been, you know, thinking like during the colonial period. I'm not joking. They are thinking like during the colonial period. Why? Because during the colonial period, the colonial administrations, they did not have any monetary sovereignty. They don't have their own currency. They were using the metropolitan currency or very vicious, very harsh exchange rate regimes like currency boards. So that means that London would say, for example, to the colonial governments in Kenya, well, you will receive no grant from us, you will receive no loans for us, except for exceptional circumstances. So you have to function on a balanced budget. That means everything you spend has to be financed through taxes and forced labor, because they had no monetary sovereignty. But when you have your own currency, you could never lack your own currency.
One of the big challenges in the present state when it comes to sovereign debt distress resolution is the fact that the sands of time have shifted. Back in the mid-90s, when we had the highly indebted poor countries debt suspension initiative, the reason it happened was because debt was largely secured from what we call the Paris Club members, the United States, the Europeans, and Japan. Currently, China has become a huge player. Saudi Arabia has become a huge player. Other players like India have come into the stage of creditors. And when you want to get them to a negotiating table for restructuring, the process has become unusually protracted and daunting because there is no dominance from the Paris Club members. So we ventured into the situation as it is right now and how we can move forward in terms of debt distress resolution.
But you know, the one fundamental problem we have is that, you know, okay, debt comes from, you know, as you know, it comes, there are many components to it. There's bilateral, there's multilateral, and there's private creditor debt, okay? And what we're really seeing is, you know, in bilateral debt, there's been a significant shift because of so-called aid fatigue. The Paris Club members, which is the developed industrial countries, market economies, have put their money, you know, and are not putting enough money. Whatever little they put it through the multilateral system. And you have, in bilateral credit, therefore, China becoming a major player, okay? And the second thing is, we know that overall, the share of private creditors in total credit, you know, has increased significantly over a period of time in all countries. So given that change in composition, you would think at one level that, you know, every creditor would think that, okay, you know, this country is very clearly not in a position to be able to generate the foreign exchange to meet its payments commitments. So let me go and settle. Let me take a haircut of some magnitude in order to be able to retrieve my losses, particularly because of the fact that I've lent at interest rates which has allowed me to recoup a significant amount of the capital that I put out. But the way in which they've prevented that kind of thing from happening. So you have a market which prices this debt, and let's say it prices it at 20 cents to the dollar or 30 cents to the dollar. And then you have an actual renegotiation system in which the way in which they manage to actually get themselves a much, much better deal, let's say where they take a haircut of 30 cents to a dollar, which means they get back 70 cents, is that they use the IMF as the police person.
So after the 2000, what happened? There have been initiatives to cancel part of the official debt, and with the heavily indebted poor countries initiative and the multilateral debt relief initiative. Yeah, so for most countries there have been significant debt relief by the mid, let's say 2005, 2006, you see. And so that means that these countries now have more policy space to go into debt again. And what happened was that between, let's say, 2005 and 2015, there have been a commodity price boom, you see. But unfortunately, most of our, extractive sectors have been privatized to some extent. So the commodity boom, all the export income was not captured by the states, by the domestic economies, but by the transnational corporations, that control those sectors, you see. And like, for example, in the 1970s, from the 2010s, with, the global liquidity cycle, the, policies of unconventional monetary policies in the global north, zero interest rate policies, quantitative easing, there have been a lot of, liquidity, in the global north. And when you have zero interest rate in the global north, it might be tempting to go to the global south to invest there, for index investment, or buy bonds to have 7% in Kenya, 10%, I don't know, in Ghana. And that's what they did. And African countries, nice, because we have good economic prospects, because we are enjoying good growth, etc. And this will continue. And so they got into debt massively. But this time, they got indebted, in capital markets. They issued Eurobonds. And that is really something different from the previous crisis, because the previous crisis, let's say in the 1980s, the debt was mostly held by official creditors, bilateral creditors and multilateral development banks, and sometimes some banks, commercial banks. But now, in significant part of the debt is held by Eurobond holders. And so it's a different dynamic, because those Eurobond holders, nothing will oblige them to come to the table to negotiate for debt restructuring, you see. So that has been the pattern. So you see, the 2000, we have good economic growth spurred by commodity prices. And when this boom in commodity prices started, to end, the countries, issued massively Eurobonds.
IMF programs and austerity-linked conditionalities, do they work for economies or do they not? That has been one of the key questions being raised, especially as we see a wave of protests sweep through markets such as Kenya, which are currently under an IMF program. So I asked my discussants whether this is a key issue and how we should look at the austerity measures which come with IMF programs, especially when countries are in situations where they are facing elevated debt distress.
The IMF basically comes with a little bit of money, waiting till the situation becomes dire and extreme in these countries, and gives you that little bit of money to shape a whole strategy in which they can extract the maximum possible by imposing austerity. So you force people to cut their consumption and their savings, because you have domestic debt restructuring, so you even reduce their savings in order to be able to release in order to be able to reduce the income so much that they cannot import even if they need it, because some countries need to import food or fuel, but you actually force this austerity on them to release this foreign exchange. So you're in some sense saying that, listen, I'm the de-risking agent for you. And it's very important for them. It's that they cannot live without these indebted developing countries, because they need to lend more, because they need to keep the money they have in hand, which is a huge amount of liquidity, moving. But they want to have some degree of confidence that there would be some kind of a ceiling to the amount that they would lose, if you want to call it that. And the IMF plays the role through its debt sustainability analysis.
So what happened was that debt distress lost decades in Latin America and in Africa. And we had, to go through the austerity programs, austerity plans of the IMF, liberalization, privatization, and macroeconomic stabilization. That means, to be in austerity mode, that means less spending, etc., for, let's say, health, education, etc. And every effort has to be done to try to repay the debt. And we did that for 2 decades, 1980 to 2000. But at one point, when you see the debt GDP ratio, external debt GDP ratio of the continent, it did not decrease between 1980 and 2000. So that means that austerity policies themselves, they could not reduce relatively the debt, because that is not the goal of austerity policies under IMF. The goal of austerity policies is to punish these countries, to impoverish them, and to allow the foreign investor to come to buy their assets, because their currencies generally are devalued. So after the 2000, what happened? There have been initiatives to cancel part of, the official debt. And with the heavily indebted poor countries initiative and the multilateral debt relief initiative. Yeah, so for most countries, there have been significant debt relief by the mid, let's say, 2005, 2006, you see. And so that means that these countries now have more policy space to go into debt again.